Hi, welcome to Alt Strategies. For anyone who's interested in anything that is way more fun than the traditional stuff that's been done over and over again, this is the place to be. And I'm so privileged and pleased to introduce the panelists who are here with us today, who are really top of the line experts in their fields and teach. Incidentally, two of them teach at my alma mater, Columbia University, or taught at Columbia University in the past. So it's always so nice to just say that. Sorry. So, all right, I'll start with quick introductions and then I'll ask the panelists to also say a couple of words about their background. Amy Hirsch is the CEO of Paradigm Consulting Services. Hi.
Hi.
And then, well, actually, why don't we go to Zoom? And Blake Singer, Managing Director with Amera Securities, is joining us via Zoom today. Hi. Can you hear us okay? Yes. Oh,
You're on mute, Blake. I think you're on mute, Blake. Yeah.
Blake,
How's
can you hear
that?
us?
Yeah.
Better. Okay, coming in loud
Most
and
people
clear.
prefer if I'm on mute, but
No, not this time. Not this time. Joshua Vandres, Helios Capital Advisors. Hi. And then right here with us, Michael Weinberg, Columbia, and he's also going to tell you about the rest of the things that he's involved in, which are numerous. Okay, so let's go in that order. And would you please just throw out some fun facts about yourselves, not just the boring, Columbia.
Okay, fun facts.
Yeah.
Well, my goal every morning is to leave my house without cat hair all over me.
How's that working?
It's not so good today. I've been in alternatives for 40 years, and I'm ex-Merrill, ex-Smith Barney. I've had my own firm since 1995. My expertise is in alternatives with a subspecialty in hedge funds. I do expert witness work for litigation. Currently working on 2 Madoff cases. I've worked on 4 previous Madoff cases. I do deep dive due diligence, investment and operations for institutions, family offices, and rogue people everywhere. And that's a little bit about me.
Thank you. Okay. Blake, if you're still unmuted.
yes. Hi, everybody.
ahead.
I'm Blake Singer, and I'm a managing director at Amera Securities, which is one of 2 hats that I wear. Amera Securities is a boutique investment bank, and we raise money for basically emerging growth companies. And my area of focus is on the medical device area. And really more apropos to this conversation, I also consult building out alternative portfolios for family offices and registered investment advisory firms. And my client right now is an advisory firm in Philadelphia where we've built out their alternative platform, ranging from big box names to small emerging managers or niche capacity constrained managers. Prior to that, I've been in the business for close to 40 years. Most of it in the alternative side. Also started at Merrill and Smith Barney. I founded and ran a $400 million stat arb hedge fund, and we closed that when the arb went away. But it did very, very well while it was running. Pulled a team out and ran a volatility arbitrage fund. We had a small fund of funds, and then I had a commodity trading company, which really morphed into a trade finance operation with offices in Brazil and South Africa. And lastly, I worked for 7 years as a CIO for a West Coast single family office.
Wonderful. Thank you so much. Joshua, next.
Yeah, my name is Joshua Vandres, and I run Helios Capital Advisors. And my background is primarily within the technology and system infrastructure space for about the last 20 years with programming protocols from network protocols to SMTP. So I decided to get into the financial technology sector and stick within that. And I've been licensed doing that since 1998. So, and that's what I do.
Wonderful, Michael.
Thanks.
Yeah.
I thought I was a veteran, but compared to the other panelists, I'm a relative newbie with only 30 years experience. So I've worked at various institutions over the last 30 years, Morgan Stanley, financial risk management. I was a portfolio manager at Soros for George Soros, and as well as the Quantum Fund. Most recently, I was at a Dutch firm called APG, large pension asset manager, and also teaching, as you mentioned, Julia, at Columbia Business School for more than the past decade now. Of course, we created, which is very much about the topic of this panel, so it's probably a good fit. It's institutional investing in the role of alternatives in institutional portfolios.
Wonderful. So speaking about alternatives, what is the alt strategy landscape these days? What does that encompass? Can you give us the lay of the land before we're going to talk, get into why do alternatives happen? What's driving the interest lately, and what each of us in this room can do as the next step to learn more about it, provided we don't know enough. And this is the area where you can learn about it for 40 years and still, the next year something new is going to come up, right? So what is the landscape? Amy, let's go in that order, because I kind of like that order. It doesn't, Blake doesn't get to relax because he gets to go second, right? So let's go this way.
I mean, the alternative landscape, they spoke about it in the last panel,
Yeah.
with private equity, which includes venture cap, growth, buyouts, et cetera. Private debt or private credit and lending is another aspect of it. And that can be done either in corporate or lit finance, litigation finance. Then there are, of course, hedge funds, which range the gamut from your long only, which I don't think is a hedge fund, to long short, which is primarily long, which is really not a hedge fund. Event driven, relative value, merger arb, convertibles, et cetera. Real estate, they talked about in the last panel. Commodities and managed futures, structured products like CDOs, CLOs, mortgages, MBS, receivables, post-litigation finance, commodities, municipalities, royalties, things like that, and collectibles, things like rare wine, vintage cars. You've got several of those, right? Fine art, stamps. I mean, alternative landscape is a very wide breadth of strategies and investment types. So,
and it's been drifting, because now when you say real estate, I'm like, that's alternative.
Right,
I mean, this
yeah.
is like as vanilla.
right, exactly. And then of course there's crypto, the latest craze. So Blake, you want to add to that?
You made it very hard, though. I mean, because your list is so.
I'm sorry, I spoke very quickly though, so I'm trying to.
I mean, what is there to add? I mean,
Yeah, I agree. Amy,
importing monkeys. I mean, come on. Okay, Blake. Tell us what else is out there.
Well, I guess broadly, I would say that alternative investments are those things you can't index, and that's really broad. But I look at it a little bit differently. We look at niche strategies, and what's happened in the landscape is that there has been a huge disintermediation of ownership of equities, from public equities to private equities, and that's created a huge market for private credit. There's been a big rise in non-bank lending, and we're seeing a lot of alternative strategies that are really essentially operating businesses that are using alternative capital or fund-based capital in lieu of other funding sources. And an example would be a fund that we know that basically is providing credit default insurance for vendors to kind of distressed retailers. That's really a business, but they've funded it. It's a really interesting strategy. And somebody once, Ed Vassar, who used to be at at Lazard used to call it alternative. And as things become more mainstream, like long short equity has become mainstream, convert arb has actually become somewhat mainstream, and there's a bunch of other areas. The frontier of what is alternative keeps expanding, and I think that's really where there is a lot of opportunity, and that's where we find a lot of interest in. So in terms of the landscape, that's kind of what I see that has occurred, and it's really very open to interpretation in terms of what is alternative. And I'm always surprised to see, and fortunately surprised to see new strategies come up, like litigation finance, that's been around for a while, but it's really an alternative strategy, and they're using fund base or the sources of capital that we're discussing to fund these things rather than bank lending and other things. So how's that?
Thank you, Blake. Josh, okay.
Alternative strategies for me is, I love the space. It's not, to me, it's anything can really become an alternative strategy now. You can borrow carbon neutrals, you can, buy a space in the cloud number 9. And I mean, literally, you can do anything. And most of it, what a lot of people I tend to think dismiss is where are these ideas coming from? Who's making them? Where are they getting advanced to? And all of that information really comes down to the internet. It's technology that is providing these fields, such as AI, which is still considered, in its own right, an asset of its own, but it really hasn't journaled into an asset that, for instance, there's only 16% of financial institutions that use them right now, but there's 40% hypothetically that are still trying to work on their own versions. So it's the information at which the speed is now coming at us that we can no longer tender in a tenable fashion to be able to discern what will be the next coming of that information, what will be the next alternative strategy. And I think that's, to me, is more important than what are the current alternative strategies, because the money's already been made there or it's being invested there. Where's the next strategy coming from? That's what I want.
And so you're distinguishing, Josh, between alternative strategies and what are alternative investments.
Yes. Yes.
Any thoughts on tokenized assets?
Wait. Michael needs to answer. We have to get to uncorrelated. Marty, somebody has to say uncorrelated. That's what I'm waiting for, okay? So please.
I was going to get to
I knew it.
but
Before you said uncorrelated, you cannot talk about AIML.
But no, but joking aside, I think Amy's list was so comprehensive that was good. But where I would comment is on Blake's comment, which is that I think what Blake was alluding to was that alpha strategies over time become beta, just as he said he had a stat arb hedge fund, which was effectively arbed away, and convert arb and merger arb used to be alpha driven strategies. And now you can effectively have them via beta, via ETFs or other passive strategies. And I think that's the interesting thing about the world that we live in, including these alternatives that, you mentioned litigation finance. I mean, we've been looking at that for over a decade, but it certainly has become more prevalent. So I would just pause there.
And not even that. I mean, if you want to really dig into the meat of all of this, which is where you all want to go, you talk about litigation finance, you've got pre-settlement and post-settlement. And pre-settlement's binary. You flip a coin, you either win, you lose. And post-settlement there's a greater chance that it will settle because it's already quote unquote settled. I used to co-manage a litigation finance firm. And the thing that I realized were that there are a lot of risks in even post-settlement. But in pre-settlement, you might as well just take your money out and throw it on the table.
It's like real options or something.
It's not even a real option. It's, and you have to know,
binary option.
You have to know so much to really do well in that. And I think that's leads to something that you said, which is, when you're looking at all of these, and you've done it for 30 years, what are the risks underlying all of these strategies that family offices, institutions don't know? People that, people like yourself that have looked at this time and time and time again, what should we look for? I mean, I think that would be beneficial to understand as well.
Yeah, absolutely. Let me get Marty to ask about tokenized assets, if that's an alt or not, because that wasn't on your list. I noticed.
Crypto.
Well,
Yeah,
it really
yeah.
isn't crypto, right? I mean,
Crypto.
it's just a different deliveries. Well, so I would say it's just, okay, fractionalized assets that are tokenized.
Is it an asset?
It's an
Yeah,
asset that's
so-
fractionalized. I mean, it's just like, you get,
You tokenize it.
Is it really?
well, I mean, if I have a real estate, if I have a building like the Empire State Building and I'm tokenizing it, and people can own a piece of it, they own an asset.
I have a view on fractionalized assets, tokenized assets. I think that it will gain some traction, but my view is that this is the way the longer term cycle will be. It'll gain some traction. It'll seem like a great idea. There will be a lot of retail, potentially family offices, small investors that come in. They will become illiquid. They won't trade well. Then there will be forced desperate sellers, then smart distressed. Alternative managers will come in and buy them at a fraction of the price, pun intended. And it really probably won't end up well for a lot of investors.
Right. First the dinosaurs came and they got big and died, and then the oil came. Yeah, we've heard the story. We've read the book. We don't want to see the movie. Now, what's great about this is the tertiary and secondary aspects of it, which are the blockchain, and what can be done using a blockchain concept. Now, there are managers out there that will trade those companies that are benefiting from it, and it's got benefits across education, a lot of different uses for blockchain technology. But I think you're absolutely right. We really read this book. I mean, how many of you lived through 94? 86. Okay, you've already seen it. We've seen this before. This is like Tulip Mania, and then nobody's old enough for that. That was like way back when.
Well, I guess the perspective is, so that crowdfunding is the thing that was passed, right? And now it's like kind of a nuclear winter for crowdfunding, right? It's a lot of these private things. And it's one thing that we've talked about a lot with Pat LaVecchia, which is that, as you do issuance of these tokenized things, somebody has to become a market maker,
Right.
right? And there's no market maker, they die on the vine, right?
With the secondary market.
Secondary,
Right.
yeah.
Right.
You really
Yes.
have two different asset classes that are asset backed. Illiquid, art on the wall, that's very interesting. Beauty's in the eyes of the beholder, who establishes that value? Or real estate,
Larry goes,
fine, but that's still a third party opinion versus real estate that's got cash flow. Or Apple, which has, I don't know, 25 billion shares outstanding.
Right.
So you have different classes of asset backed, illiquid, art. This is a beautiful asset.
I think another issue with
Is
With
art
tokenized-
illiquid? You've got NFTs.
Yeah.
Yes, but no, because it's not an NFT. It's an asset-backed security, which is either illiquid, which is one example that I've given, or liquid. But regardless, selling is one thing. Having it on a secondary market for the liquidity on the resale, which is what Marty spoke about, is a whole nother matter.
So the two aspects of fractionalization are that you need, number one, a market maker once you
Yeah.
fractionalize stuff, and number two, there's regulatory aspects to it, right? Because in some respects, some of this stuff can only be owned by accredited investors, and others can't, right? But I'm under the impression that, private equity assets that can only be owned by accredited investors, like a fund, the assets underlying it can be owned by, will ultimately become ownable by retail investors.
Well, you got 12-year-olds making this stuff in their basement.
There you go.
9-year-olds.
Right, so I'm just saying there's a regulatory.
Right.
Yeah, totally. So we're hitting on risk, right? Liquidity risk and all sorts of risks. So why don't we just go there?
Sure.
Amy, you started it.
So-
I started- you started it.
I'm sorry, Blake.
no,
Who's comfortable with real estate? Who's invested in real estate? Hard real estate. Okay. Totally illiquid, right? You get cash flow from it, etc. Totally illiquid. Everyone's fine with it. Lending can be very illiquid. Look at a a credit fund, a private credit fund, could be really illiquid. Are you investing in it? So what's the difference with liquidity or illiquidity between a private credit fund and real estate? From a liquidity standpoint, from a risk standpoint.
Yeah, so this actually gets to the crux of the matter that's been gnawing at me forever, which is that anything that is like an alternative investment that doesn't have a liquidity premium, it seems to be off. I can say that private equity returns XYZ better than the market, but private equity must have a liquidity hurdle of some sort, right? Because it's not liquid, right? So
It's massively liquid.
Correct.
that's what I'm saying, right?
Compared to the public markets, it's incomparable.
Right.
You're in a 12-year, 13-year funds with
Your
extensions.
children are in it.
You're in
Right,
13-year
so-
funds versus daily liquidity.
Right,
Correct.
it's not really apples to apples when you compare the two as investment.
Right.
Absolutely.
Vehicles, right?
That's right, but there are products that you can buy that give you some liquidity. PineBridge, for example, it has a flexible credit product where it's predominantly private credit, but there's a liquid side and they maintain like 20% to meet liquidity. So there are ways that you can get liquidity out of some of these assets, and you can enjoy both sides of the premium, the premium of yields.
But as long as they're structured to avoid a recurrence of 2008, 2009,
Right.
post-GFC,
Exactly.
where when there's a run on the bank, there is enough liquidity
That's
to
right.
sustain it.
Right, exactly.
Blake,
So-
quickly, yeah, your comments on the risks.
Yeah, so with fractionalized assets, I think one, and something Michael just brought up is, what happens in a kind of a black swan environment where you have counterparty risk, and we've seen some crypto platforms that have been heavy into borrowing that have just gone, they've been vaporized overnight. There was one that borrowed $600 million and it got vaporized. So counterparty risk is real. And the other thing is that, Amy, you'd mentioned that there are kind of liquid alternatives or liquid ways to get into some of these relatively illiquid assets. And again, anytime you have a liquidity that doesn't match up with the underlying liquidity of the asset, you've got a problem when everybody wants to get to the door at the same time. And the 20% or whatever percentage that might be allocated to, quote, providing liquidity, or the bank lines that they have, will be tapped, I would think, pretty quickly. When everybody's trying to get out, particularly with I believe with some of these fintech aggregators. I think Case and iCapital are fantastic, or even some of the interval funds, but they're taking relatively illiquid assets and they're trying to create a liquid access point to that, which at some point that may not work. Kind of going back to an opportunity with fractionalized assets, if the bottom falls out, the same thing could be true with some of these fintech aggregators, that a lot of the retail clients have gotten into these. They're great. They've democratized alternatives. But at some point, if everybody wants to get out, there's going to be very low bids and opportunities for distressed managers to come in and buy this stuff.
Right, but the one reality, Blake, is that if everyone wants to get out of everything, any manager can pull the liquidity, because every PPM says we
As a
can
gate.
suspend redemptions. So, and everyone's at risk of that. I don't, we can't imagine what we can't imagine or have experienced. So we don't know what that situation is going to be. And you can't invest. I mean, the last panel hit a couple of really good points, but the biggest thing that you need is diversification. Diversification across all these assets, and diversification against liquid and illiquid. And that's what really protects your portfolio.
You had a question.
He was waving to somebody.
Oh,
I had a comment, Julia,
About 5 minutes.
on Amy's point earlier, which is I think the issue with private credit, so literally today, Kaya published an article I wrote called Busted. And I'm a huge proponent of private credit. I think it makes a lot of sense. I think there are a lot of reasons for it to exist. I think you can access strategies that you couldn't, alternatives. There are excess returns to be had on a risk adjusted basis. But I think what you've had since the GFCs over the last, so now 14 years, is you've had a massive amount of lending without workout experience or collection experience in a generally, 14-year favorable credit dynamic and credit market, falling rates or low rates or negative rates. And I think now probably we're in for rougher times, probably rising rates, increased defaults. And then I think, it's a bit like that overused cliche that some people attribute to Buffett. You see who's swimming naked when the tide goes out. There are a lot of it's easy to lend money, but collecting it's the hard part.
That's right.
And I think that's what you have to, in families and family offices, as well as other investors, need to be increasingly careful of that their firms have the collection and workout experience.
Thank you. Josh, I would like you to talk a little bit about the new shiny objects, AI/ML, how that's driving. Basically, technology is now powering a lot more. So even in terms of collections, right? I mean, our capabilities are not what they used to be even 10, 20 years ago.
It's so a lot of the challenges in the market as far as research goes, looking at fact tested information. These are things that I personally believe that they're broken. They're not, the market no longer trades at the same rate of speed. Even with just Virtu and Citadel sitting on the box, you're trading at 4,000 times the rate of speed that you normally would. So there's no way for Mr. Mom and Pop, even, whoever it is, to sit there and justify, okay, well, which buy is this, which bid is this, which offer is that, and where is this information coming from? Is it valid? Is it a smoke screen? Is it fake information? So, because of, this coming age of supposable quote unquote digital age, I really do think it's better to, again, I keep harping on this word, but it is a key commodity. And if you don't have the information going forward in a cycle, instead of looking behind, then you're done. The economy right now, the United States is no longer a United States economy. We haven't been for a decade, at least. We are now a one world economy, whether we like it or not. So all the chipset orders that come across, nobody talks about uranium, which is the only mineral that happens to be sourced from, you guessed it, Russia. And then the other solar, which is obviously silicon, which comes from 90% of China. So how are we getting these assets in to make these billable goods? Oh, that's right, we're not. So then we're sitting there with basically a bucket of inventory. And if you look at the ISM numbers, they're there to back it up. 55 down to 47, down to 48, down to 43, and they're sitting on 68% inventory levels with no sale rates. That's Cisco, that's AMD, that's NVIDIA. And then for me, what I like is the one thing I do like about the alternative space is it still is the wild, wild west. And because of that, it gives us many opportunities within the AI space. Especially not so much with AI, but natural language processing. So you can take, and what we've done is we're developing, as a thing for me, to go out there and scan 430,000 different news sources around the globe. Who's the relevant author? Which one is the best information? Which one is not the best information? And to distinguish and itemize that and look for forward-looking information. That's what, in my opinion, we need to do, because it's very clear that back testing and, this thing called a PE doesn't work when it comes to tech, and it has not. So, but yet we keep using them. So it's the same as the old boss, same as the new boss sort of thing. And I think it gives us a great way to segue into a newer kind of look into AI. And granted, opening it is opening Pandora's box to a degree, right? A lot of people are scared of AI. But if people really educate themselves and understand what AI is and the machine learning behind it, for the first time, just in the fintech industry, they're calling it a $30 trillion a year industry in 20 years from now.
Right.
That's a big
So,
deal.
so in the investment, so do you agree with the following statement? In the investment world, the informational advantage that's gonna come largely from NLP, machine learning, et cetera,
100%.
that's where you're gonna find, that's how you're gonna
100%.
make money.
Yeah.
And everything else that's more traditional is gonna be,
I think that they
tapped out,
still need to have a
essentially.
manager
Mhm.
that knows what they're doing on the fundamental side. There's still a lot of information that, book to bill ratios, things of that nature.
you'll
that
get
are
to
all
say yeah or no,
squandered.
don't laugh.
We
now.
we have about
Yes,
2
no?
minutes left.
And
Okay.
so I do
But-
think that there's a lot.
I have a master's degree in AI, by the way, so I got my MBA award, but
Your
one thing I have
time's
to say
coming in the
is that
next 20 years.
there are things that are very static in life. From a transactional point of view, you don't need AI to examine them, right? People know how they work. It's buy them, you sell them, right?
Right.
So they're not very complicated. So I think, I used to run marketing for a casino many years ago, and we use a lot of big data analytics, and the reality is you can only get so much pop from them, right? It's very limited pop.
Well, it
You can
depends
get
on
people to
But
buy
it's-
more, and then they get satiated, so you're bringing the curve in, or
I
you
get
get, somehow you have to try to reach out to other people, while
Yeah.
everybody else is using the same tools you're using.
And all these darn humans running around with different behaviors,
They're
screwing
in the
up,
way.
screwing up your
Right,
bag,
They're
right?
in the way.
But Marty, you have big data now. It's
Yeah,
AI
it's-
plus big data. So now in the next 20
Michael?
years.
Yeah, I'm a huge proponent in what Josh is espousing in terms of machine learning and alternative data, revolutionizing not only investing alternatives, but all industries,
Yeah.
everything. Yeah.
Yeah.
I mean, because
Yeah.
some years ago, I co-founded a company called Move 37, focused exclusively on managers using machine learning and alternative data. And I do think that's the future because you can do it faster, cheaper, more efficiently than humans can. Like what
Yep.
Josh is talking about, you can scan the whole world's information in a fraction of a second.
Mhm.
Whereas we as discretionary human analysts or PMs, how many papers can we read at a time? It's just incomparable.
So you're gonna suck the alpha out of everything if we're all doing it, right?
Yeah, that's what happens
pretty
is that
much.
it kind of becomes
Right.
all beta, right?
Right.
That's the definition
Yeah.
of beta.
Well, again, alpha becomes
Right,
beta, as we
right.
said,
Yeah.
but then you'll have to find new sources. Like there's Internet of Things, there's
Correct.
corporate exhaust data, there's Freedom of Information Act filings, FOIA filings. In other words, there's satellite data and credit card data are no longer alternative data in my view. They're commoditized largely.
And it's not only that, Marty, but to go more to your
I
point,
agree.
it's not just about the AI. It's about the AI is the platform to which NLP is based off of. So for me, if you can develop 12 buckets, one for macro, one for finance markets, one for news feeds, one for whatever you want, then at that point in time, it gives you a galaxy of companies to choose from that give you a better.
So I'm gonna table this, we're gonna have but we're gonna set aside a whole topic for this discussion in Miami, during our Basel, so you guys are welcome to come and speak, I'm not paying for your flights. But you're welcome to come down or to be online like Blake and speak about, about AI and machine learning and investments as an alternative. So I think it's great that you can crunch all this data at the same time. One last question.
One question, why isn't AI applied to fundamental analysis in all these?
It is.
It is.
It is.
You haven't talked about that.
Well, no, because
It's an
I
alt
don't
channel.
think
It's an alt.
it's within a bucket, right? So
Yeah.
I put things in a
Yeah.
bucket.
Yeah. So the
But
question
it is. There are many funds
Yes.
using machine learning and alternative data, basically replacing what I did as a discretionary portfolio manager at Soros. Many funds are doing that now, faster, cheaper, more
And
efficiently.
this isn't new, right? I
No.
mean,
Not
Mark
at
Ritchie
all.
was doing this in Chicago back in the 80s.
Yeah, but to Josh's point, or someone's point, you have this confluence of machine learning being evolved, record amount of data, record low processing and storage costs, and data science. And you didn't have that confluence of four factors
Right.
5-10 years ago. It's now within the last 10 years that this has all coalesced.
Mhm.
So are you gonna be replaced by a machine one day?
A lot of roles will be.
I will miss you.
Thank you.
Yeah. And with that,
You know,
great job, guys.
there are,
Right?
I was just gonna say, real quick, Amy, to answer your question, there are now on bond trading desks, AI-driven traders essentially, that rather than a trader looking at, the relative value of a bond that trader is trading, this AI will not only look at the relative value, but they'll also look at the book that the investment bank has and measure that particular position against all the other positions, which could be a very different determination than whether or not that trader thinks it's a rich or cheap bond. And that does replace traders. I mean, that's a great example of how this works. And
Until it
will
doesn't.
make spreads tighter, and it will create opportunities to find the next frontier.